Good evening to all the students of ICAI present across India. I am C. Anirvinna. Today I am presenting money supply as part of the money market chapter. Okay. Now before I talk anything about money supply chapter reminds me in a typical hospital surgery section where you have anesthesia, right? So anesthesia is given by a doctor to a patient who is undergoing for a treatment. Okay, anesthesia should be given to the extent required by the patient for the time of operation. If you give more anesthesia, patient will die. Okay, if you give less anesthesia, it creates problem at the time of surgery. So you need to give optimum anesthesia, keeping in mind time required for the surgery. So you should not give more, you should not give less. Similarly, money supply, okay, which is done by RBI, should be done according to the money demand. You should not supply more money supply, you should not less money supply. If you supply more money, if you do more money supply in the economy, money supply more than the money demand, rate of interest falls. When rate of interest falls, people start demanding goods and services, and if there is no corresponding supply, it might lead to inflation. Okay, so money supply should be done according to the money demanded. Okay, so both are together. Money supply, money demand decides the rate of interest. So money supply for me is like a anesthesia, right? You need to supply optimum level of anesthesia to the patient. Similarly, money supply should be demanded in accordance with the money demanded by the economy, not more, not less. Okay, now let us go to money supply. Okay, so learning outcomes of money supply chapter. We are discussing what is money supply here, different concepts, different components of money supply, rationale of measuring money supply, different sources of money supply, illustrate the various measures of money supply, distinguish between money multiplier, credit multiplier, deposit multiplier, okay, different determinants of money supply. So these are we are going to discuss in 2.5 hours session today. Okay, these are the learning outcomes. These are the topics I'm covering in brief. Okay, now money supply. So who supplies money to the economy? RBI supplies money to the economy. Okay, please remember, RBI only supplies money to the economy, not government, right? So don't say government. RBI supplies money to the economy. Okay, so money supply refers to the total sum of money available to the public in the economy at a point of time, usually taken as a year. Money supply refers to the total supply of money available to the public in the economy at a point of time, usually taken as a year. Okay, now the most baffling question is whether money supply is a stock concept or flow concept. Okay, supply of money is always a stock concept. Okay, supply of money is always a stock concept. It is measured at a point of time, and changes in money supply, increase in money supply. If you take increase in money supply, decrease in money supply, then it becomes a flow concept. As such, supply of money is a stock concept. Okay, stock concept. Now, what is the rationale of measuring money supply? Rationale of measuring money supply. Okay, rationale of measuring money supply is to differentiate between those who supply money and those who use of money, right? It's public who is using money, right? So those who supply money and those who manufactures money. So to differentiate these two things, we always use this is a reason behind measuring money supply, right? Supply from manufacturing of money. Differentiate between manufacturers of money supply and from the users of money supply in the economy. Okay, now source of money supply. Okay, now source of money supply. Source of money supply. Before we discuss source of money supply, money is supplied by RBI in the economy. So it is a liability on the part of RBI. It should be backed up by an equivalent amount of assets in the form of foreign securities. Okay, and monetary policy. Okay, monetary policy deals with the money supply in the economy, right? with a view to encourage growth and at the same time control inflation rate in the economy. Control the inflation rate in the economy. So monetary policy, okay. And before this introduction, I want to tell you this. Throughout this course, we are going to talk about two doctors. One is monetary policy. Monetary policy used by RBI. RBI is one doctor, okay. And and fiscal policy is used by Government of India is a second doctor. So we have two doctors for the economy. We have two doctors for the economy. We have two doctors for the economy. One is RBI. Second is government. Second is government. Okay, so for us, we have so many doctors. For RBI, for economy, only two doctors are there. Monetary policy is led by RBI, is one doctor. Fiscal policy is led by Government of India, is second doctor. Okay, from April 1997, RBI employs four concepts of money supply. Okay, four concepts of money supply. Okay, M1. M2, M3, M4. Okay, so M1 is also known as narrow money, that is equal to currency in circulation plus demand deposits with the banking system plus other deposits with RBI plus other deposits with RBI. Okay, now currency in circulation, you know that all rupees coins. Demand deposits, okay, deposits that can be demanded at any point of time. Okay, so which deposits can be demanded at any point of time? All saving deposits, okay, held by your papa, me, and everyone, right? Everybody has a savings account. Okay, the money in savings account can be demanded at any point of time. Okay, bank cannot say I won't pay. Okay, bank cannot say I can't pay. Okay, so demand deposits, nothing but saving deposits, but it does not include recurring deposit, fixed deposits. Fixed deposit, recurring deposits, okay, they stipulated by time, right? You can't withdraw. If you want to withdraw, you have to pay penalty for fixed deposits and recurring deposits. Demand deposits, here we are referring to all saving deposits, okay, and other deposits of RBI. Okay, other deposits of RBI includes Unit Trust of India, NABARD. Okay, NABARD is the apex bank in agriculture sector. World Bank, IMF, IDBI, IFCI. Okay, these are all the other deposits of RBI coming from UTI, NABARD, World Bank, IMF, IDBI, IFCI. So M1 comprises this. Okay? M1 is equal to currency in circulation, demand deposits with the banking system plus other deposits with RBI, and other deposits are coming from UTI, NABARD. NABARD is the apex bank for agriculture sector, World Bank, IMF, and IDBI and IFCI. So M1 is known as narrow money. M1 is narrow money. M1 is narrow money. I hope you are able to. Okay. Okay. So we are talking about money supply in the economy, and these are the four concepts of money supply: M1, M2, M3, M4. M1, M2. Hope you are able to follow with me. Mansha. Fiscal policy led by government, emphasis on demand of money. Mansha, fiscal policy does not deal with the demand for money. Okay, okay. Fiscal policy deals with government expenditure and taxes. Okay, okay. Please ask me any doubts. And okay, clear. Now we deal with M2. M2 is equal to M1 plus post office saving deposits. Post office. So post office, every post office has savings account. Okay, every post office has savings account facility. Okay, every post office has savings account facility. But you need to remember, post office comes under the control of Government of India. Okay, post office is not controlled by RBI. Post office controlled by Government of India. So M2 is equal to M1 plus post office saving deposits. Okay, now, so every post office also savings account. Like bank, you have a savings account. Post office also has a saving account. M3 is equal to M1 plus time deposits with the banking system. Time deposits. When I say time deposits, we are talking about here recurring deposits and fixed deposits. Okay, now recurring deposits can be 6 months, 1 year, okay, 2, 3 years, 5 years recurring deposits. Fixed deposits can be also stipulated by time, 1 year, 2 years, 3 years, okay, fixed deposits. So earlier in India, what happened? The interest rates that is offered on recurring deposits is lower than interest rates that is offered on fixed deposits. But unfortunately, last 1 year, 2 years, I see there is no difference in the interest rates that is offered on recurring deposits, interest rate that is offered on fixed deposits. Okay, what is recurring deposit? Every month you have to contribute 1,000 rupees. Assume every month you want to contribute 1,000 rupees. Every month you have to contribute 1,000 rupees for 2 years, 1 year, 3 years. Bank will pay rate of interest. So at the time of maturity, you withdraw that money. Fixed deposit means your papa might put 1 lakh rupees on your name in fixed deposit for 1 year, 2 years. After 1 year, 2 years, bank will pay principal and rate of interest. Okay, so what is happening currently is the interest rates that is offered on recurring deposits and fixed deposits, there is no difference. Okay, interest rates are almost same. Okay, now the interest rate offered on savings account is called deposit rate. The interest rate that is offered on savings account is called deposit rate. Okay, if you have a savings account in the State Bank of India at Punjab National Bank, we call it interest rates on savings account. Okay, we call interest rates on savings account. That's also correct. I'm not saying that, but actually the name of that is deposit rate. Name of that it is deposit rate. Deposit rate. Interest rate that is paid on savings account is called deposit rate. Some people say interest on savings account, interest earned on savings account. That also you could say, but actual term is deposit rate. Okay. Now M3 we discussed. M1 plus time deposits banking system, right? So all banks have time deposits, which includes recurring deposits and fixed deposits. So M3 is known as broad money. M3 is known as broad money. M3 is known as broad money. Karthik Gupta, the categorization is done. See, this categorization is done to segregate money supply, right? So some people are keeping money in savings account, some people are keeping money in the post office, some people are keeping in fixed deposits, some people are keeping in recurring deposits. Okay, so some people are keeping in recurring deposits of post office, some people are keeping fixed deposits in post office. We want to segregate. Okay, see, this segregation was suggested by a committee, right? Based upon that, we are following. Yes, Jaspreet. Recurring deposit, you can deposit 500 rupees, 1,000 rupees for a period of 1 year, 2 years, 3 years. Okay, fixed deposit is one time only, one time investment for 1 year, 2 years, 3 years. So that you get along with principal and rate of interest in both the cases. Clear, guys? Now M4. M4 is equal to M3 plus total post office saving deposits. Total post office saving deposits means what? In post office also we have a savings account, we have recurring deposits, we have fixed deposits, excluding NSC, National Saving Certificates. National Saving Certificates. Okay, so Indra Vikas Path, Kisan Vikas Path, this patra are being excluded. This patra are being excluded. This patra being excluded. Okay, so M4 is equal to M3 plus total post office saving deposits excluding NSC means Indra Vikas Path, Kisan Vikas Path. This path are being excluded. Clear? Till now clear what I'm saying? All of you are with me? Okay. Now we discussed money supply components. Okay. Now we move to on the recommendations of working group on money supply on money in 1998, new money aggregates have been followed. Okay, on the recommendations of the working group, money 1998, new money aggregates are followed. Okay, so RBI started publishing new money aggregates. Okay, on the basis of working group on money supply. Okay, so first one is NMO. Okay, the NMO is a term is not there in textbook. Please write. It's called NMO. In textbook it is written as reserve money. Reserve money nothing but NMO. NMO. Haragava, interest on savings account has become very low, negligible. See this Indira Vikas Patra and Kisan Vikas Patra, this Patra have been issued by Government of India as part of IT exemption. So you have to keep this Patra for 5 years, and if you keep this Patra for 5 years, your amount will become double, and you of course you can get IT exemption also. Okay, so NMO is also known as reserve money. So that is nothing but currency in circulation and banker deposits with RBI. Okay, all banks have current account deposits lying with RBI. All banks have current account deposits lying with RBI. All banks have current account deposits lying with RBI. And other deposits with RBI, we discussed World Bank, IMF, okay, NABARD, they have the other deposits with RBI. NM1 is equal to currency with the public plus demand deposits with the banking system plus other deposits with RBI plus other deposits with the RBI. NM1 is equal to currency with the public, demand deposits with the banking system plus other deposits with the RBI. NM2 is equal to NM1 plus short-term deposits of residents. Okay, short-term deposits. Okay, okay, up to 1 year. Okay, short-term deposits of 1 year. Okay, so NM3 is equal to NM2 plus long-term deposits of residents. Okay, long-term deposits means more than 1 year. Okay, more than 1 year plus call or term funding from financial institutions. NM3 is equal to NM2 plus long-term deposits of residents, that's more than 1 year, plus call or term funding from financial institutions. So call, you know that call notice, call notice, and is what when borrowing indulged by one bank from the other bank, as from borrowing indulged by from one bank from the other bank. If SBI borrows from Punjab National Bank, okay, it's called call notice or term money notice or term money notice. That also comes under here. Jaspreet, money supply. So money supply. How much money is is supplied to the economy decided based upon the money demand. Based upon the money demand. So they estimate the money demand based upon that money supply is done in the economy. Okay. Okay. Clear, guys. Clear, guys. So we discussed NMO, reserve money, NM1, NM2, and NM3. So On the basis of recommendation of working group on money, 1998, new monetary aggregates also been framed. So they are liquidity aggregates. Liquidity aggregates. Okay. So first one is L1. L1 is equal to NM3 plus all deposits with the Post Office Savings Bank, excluding National Savings Certificates. Excluding National Savings Certificates. NM3 plus all deposits with Post Office Savings Bank, excluding National Savings Certificates. Okay. Now L2 is equal to L1 plus term deposits with the term lending institutions and refinancing institutions. Try to understand this. L2 is equal to L1 plus term deposits. Okay. Term deposits means here fixed deposits also known as term deposits with term lending institutions. Okay, you should know what is called, what do you mean by term lending institutions. Okay, State Financial Corporation, IDBI, okay, State Industrial Development Corporation. I repeat again, State Financial Corporation, Industrial Development Bank of India, State Industrial Development Corporation. They are all called term lending institutions. They're called term lending institutions. Okay, and refinancing institutions. Okay, so what is refinancing institutions here? NABARD. Okay, National Housing Bank. They're all called refinancing institutions. Okay, and term borrowing by financial institutions. Sometimes what happens? Financial institutions borrow from fixed rate from one the other. Okay, sometimes financial institutions borrow at a fixed rate from the other. And certificate of deposits issued by financial institutions. You know that money market as part of money market instrument, certificate deposits also a bank can issue to raise the money. Okay, L3 is equal to L2 plus public deposits of non-banking financial companies. L3 is equal to L2 plus public deposits of non-banking financial companies. You know what is non-banking financial companies? Investment banks, insurance companies, okay, hedge funds, they all come under non-banking financial companies. Jaspreet, why you worried about the National Savings Certificate? National Savings Certificate is a tax saving piece of paper. Okay, you can buy, your papa can buy from post office. Okay, it is the National Savings Certificates may be term for 10 years, 20 years. Okay, and it will double the amount and you get IT exemption also. Liquidity means what? Money aggregate only. Hiral, liquidity aggregate means money. Liquidity means money only. Okay, instead of saying money aggregate, they're saying liquidity aggregate. Karthik, I didn't get your question. Karthik, I didn't get your question. Karthik, I didn't get your question. And M3 is called broad money, M1 is called narrow money. Okay, broad money in the sense that the number of items that is being considered as part of M3 comes under broad money. Mansha, I didn't get your question. Clear? Karthik, I didn't get your question. So liquidity aggregates L1, L2, L3. Okay, liquidity aggregates nothing but money aggregates only. Okay, so they kept on reframing these aggregates. Okay. Now we'll move to reserve money or base money or government money or high power money. Okay. Reserve money, base money, government money, high power money. Who supplies this money? Who supplies this money? RBI supplies this money into the economy. Okay. The money supplied by RBI into the economy is called reserve money, base money, or government money, or high power money, or base money. Okay. The money supplied by RBI is called reserve money, base money, or government money, or high power money. Okay. So how do you measure this high power money? How do you measure this high power money? How do you measure this high power money? Okay. So the measure of high power money is equal to H is equal to C plus R plus O. C plus R plus O. C plus R plus O. H is equal to C plus R plus O. C plus R plus O. Okay. Now what is this H? Okay. Now what is H? H is nothing but high power money, which is also known as reserve money, base money, government money, high power money. C, where C is currency held by public. Currency held by public. Okay. So we hold rupees, coins. Okay. Now R is cash balances of commercial banks. Okay. R is equal to cash balances of commercial banks. Okay. Cash balance of all commercial banks have cash balances. O is other liabilities of RBI. Okay. O is other liabilities of RBI. We discussed now UTI, IMF, World Bank, NABARD, they keep their funds with RBI. These funds are negligible. These funds are negligible. So since it is negligible, for all practical purposes, we consider high power money is equal to C plus R. Ayush Agrawal, liquidity aggregates, money aggregates. See, liquidity aggregates have been reframed from money aggregates only. They are not something different. Okay, H is equal to C plus R. Mahesh Chevron. Mahesh, see, term borrowing means it's a kind of a fixed borrowing by the financial institutions. Okay, one bank can borrow from other bank at a fixed rate. Okay, so fixed money they can borrow. That's called term borrowing. Fixed. Okay, now all of you understood reserve money. Reserve money. So I repeat again, reserve money, high power money, base money, government money. This money is supplied by RBI into the economy. So how do you measure this? H is equal to C plus R plus O, and O is insignificant. O is insignificant. That is, other liabilities of RBI is insignificant. That's the reason why, for all practical purposes, we consider high power money is equal to H is equal to C plus R. Clear? Clear, guys? Clear? Clear, guys? Okay. Now we'll go to money multiplier. Okay. Money multiplier. Okay. What is money multiplier? So I'm denoting money multiplier as small m. It refers to the degree to which money supply expanded as a result of increase in high power money. It refers to the degree to which money supply expanded as a result of increase in high power money. So thus money multiplier is equal to small m is equal to m upon h. M upon h. M upon h, where m is equal to money supply, h is equal to monetary base or high power money or base money or reserve money or government money. Okay. Now this, so we discuss what is money multiplier. It refers to the degree to which money supply expanded as a result of increase in high power money. As a result of increase in high power money. So Thus, M is equal to M upon H is equal to where M is equal to money supply, H is equal to monetary base. Okay. Now, the size of money multiplier is again in turn determined by three major factors. Okay, three major factors. The size of money multiplier is in turn determined by three major factors. Cash reserve ratio set by commercial banks. Okay, what is cash reserve set by commercial banks? Out of total deposits, every bank should keep 4% as CRR. Every bank has to keep 4% as CRR, cash reserve ratio. Okay, now excess reserve ratio set by banks. Cash reserve ratio is denoted as R. Excess reserve ratio set by banks E. Excess reserve ratio. It means sometimes I'm out of 100 rupees, I need to keep 4%, that is 4 rupees. Sometimes I may keep 6 rupees or 7 rupees excess reserve. Okay, why I keep excess reserve? Because I'm fearing sudden emergency for a loan. Okay, sudden requirement, sudden withdrawal is happening in my bank. So that time I need excess reserve. Okay, so excess reserve. Okay, cash reserve ratio out of 100 rupees, 4% means 4 rupees. 4 rupees I'm going to keep as cash reserve ratio. I'm keeping excess reserve ratio. It means I'll keep more than 4 rupees. That is, I'll keep 7 rupees excess reserve ratio. Keeping in view, if tomorrow sudden withdrawals are happening in my bank or any loan requirement arises, I need to keep extra cushion. That is called excess reserve. Excess reserve set by the banks. Excess reserve set by the banks. Puja is insignificant, negligible, both are same. Because Tanu, this is called Tanvi, it's called insignificant because the amount is negligible proportion. That's why it's insignificant or negligible. Okay, for all practical purposes, deposits held by IDBI, IMF, World Bank, NABARD, UTI, it is considered to be negligible, insignificant. Okay, now see, the purpose of cash reserve ratio is to protect the interest of the depositor. Okay, so we have insurance scheme. Okay, we have bank insurance scheme, but still purpose of CRR is to protect the bank. The purpose of CRR is to protect the interest of the customer who deposits money in the bank. So 4% is CRR. Right now, what does every bank do? Over and above CRR, they keep certain money as excess reserve. Okay, excess reserve. They keep certain money as excess reserve. Okay, why they keep certain money as excess reserve? Tomorrow, sudden withdrawal might happen, or any loan requirement arises. So I need money. So I keep excess reserve. Now, currency deposit ratio of public. Now, currency deposit ratio of public. It means what? How much currency your papa is depositing in the bank, right? Now, your papa income is 1,000 rupees, right? How much of that 1,000 rupees your papa, 1,000 rupees what? He has to consume goods and services. He has to pay rent. He has to buy vegetables. But how much of that currency he is depositing with the banking system? So currency deposit ratio, okay, that is denoted by C. I repeat again, we discussed cash reserve ratio, small r, okay, and we discussed excess reserve ratio. Every bank keeps over and above cash reserve ratio as a cushion in case of any emergency. And currency deposit ratio of public, right? How much currency public are depositing with the banking system? Okay, how much currency public are depositing with the banking system? Any doubts here? Okay, Pooja, I'll correct that thing. Okay, thank you, Pooja. It's insignificant. Yes, you are right. You are right, Pooja. You are right. But I never said significant, Pooja. Yes, yes, Prince. Money supply is money multiplies in the economy. You're right. You're right. You're right. Yes, Jaspreet. There are several multipliers are there. Tax multiplier is there. Investment multiplier is there. Okay, and there are so many multipliers are there. That's not part of your study. Okay, and Karthik, I'll talk about excess reserve later. Please kindly wait. I'll respond to your point, Karthik Gupta. I'll respond to your excess reserve point later. Okay. So we discussed money multiplier is in turn determined by R, cash reserve ratio, excess reserve ratio of banks, small e, currency deposit ratio of public, C. So we'll rewrite this equation. Money multiplier small m is equal to m upon h is equal to 1 plus C upon R plus E plus C. R plus E plus C. M upon H is equal to 1 plus C upon R plus E plus C. R plus E plus C, where R is equal to cash reserve ratio, okay, and E is equal to excess reserve ratio set by banks, okay, over and above cash reserve ratio. C is currency deposit ratio. Currency deposit ratio. So money supply is equal to 1 plus C upon R plus E plus C into H. Okay, money supply is equal to M is equal to 1 plus C R plus E plus C into H. Clear? Shreya, money CRR is set by RBI. All banks in the country have to keep 4% of the deposits with RBI 4%, okay, in the form of cash. Karthik, how does money supply itself in there? I don't know. Karthik Gupta, your question is not clear. Hiral Parekh, I explained money multiplier. See, when RBI supplies money into the economy, how it gets multiplied. Okay, it refers to degree which money supply expanded as a result of increase in high power money. Who supplies high power money? RBI supplies high power money. When RBI okay. Now look at this equation. This equation, M upon H is equal to 1 plus C upon R plus E plus C. So how do you interpret this equation? This equation can be interpreted as money supply is directly proportional to high power money, inversely related to R, E and C. Okay, money supply is directly proportional to high power money and inversely related to R, E and C. R, E and C. Inversely related to R, E and C. Okay, so directly proportional. Okay, if money supply increases if whenever there is an increase in high power money. Okay, so directly proportional. Money supply is inversely related to cash reserve ratio, excess reserve ratio, and currency deposit ratio. So actually the money supply in the economy depends upon the behavior of central bank, commercial bank, and general public. Okay, behavior of central bank, commercial bank, and general public. Behavior of central bank. If central bank decreases the CRR, then more money supply in the economy. There's more money supply in the economy. If commercial banks keep less reserves on their hands, okay, then there is more money supply in the economy. If people in the country keep more currency with the banking system, then there is a more money supply in the economy. There is more money supply in the economy. Hitesh, your question is not clear. Okay, Hitesh, your question is not clear. Karthik, money supplied by RBI, okay, will have a multiplier effect on the economy, in the sense that, see, when RBI issues money, so when RBI supplies money and your father borrows money from commercial banks, okay, now your father spends that money on some commodity and seller will give that commodity to somebody else. How money changes hands? It gets multiplied, okay, gets multiplied over a period of time. Gets multiplied over a period of time. Hitesh, your question is not clear. Please type clearly. If you don't type question properly, I can't take your questions. I don't understand, Hitesh. SIT, I don't know what you're saying. What is SIT? You're saying SLR, SIT. There is no term called SIT. What you're writing? If you don't, please type your question clearly to the teacher. Okay? Now let us understand this very important thing. So, money supply is directly proportional to hyper monetary base. Money supply is indirectly related to R, that is cash reserve ratio. Money supply is indirectly related to excess reserve, and money supply is indirectly related to currency held by the public. Currency held by the public. What I mean to say is, if RBI supplies more money, then money supply will be more. And if CRR, if central bank reduces the CRR, okay, then there is more money supply in the banking from the banking system. If Central Bank of India increases CRR from 4% to 6%, again banks have to keep more money as cash reserve ratio, then there is a less money supply in the economy. If banks keep excess reserve more, again there is less money supply in the economy. Similarly, if people in the country consume more goods and services, keep less money with the banking system, again there is less money supply in the economy. On the other hand, if people keep more money with the banking system, then there is more money supply in the economy. Clear? Okay. Clear, guys? Are you able to follow me? Please type your questions clearly. I'm answering all your questions. Yes, Mansha. Fiscal policy is effective only when there is accommodative monetary policy. Yes, you're right. Sir, money supply in second point. What do you want to say, Muktabir? What do you want to say, second point? Money supply, second point means what? I wrote, money supply is directly proportional to monetary base. Okay, high power money. Money supply is inversely related to R, that is cash reserve ratio. Money supply is inversely related to E, excess reserve. Money supply is inversely related to C, currency deposit ratio. Money supply is inversely related to currency deposit ratio. Your papa salary is 1,000 rupees. Okay. Now if your papa keeps, if your papa keeps 10 rupees, okay, your papa keeps 10 rupees with the banking system, your papa keeps 10 rupees with the banking system, then the money supply is low. Your papa is keeping more money, 1,000 rupees, your papa's salary. Suppose your papa is keeping 400 rupees with the banking system, more money supply in the system. Okay, bank lend money from your papa money only, right? Suppose your papa keeps 100 rupees, less money supply. Your papa keeps out of 1,000 rupees, your papa keeps 400 rupees, then there is more money supply in the account. Clear? I'm able to answer? See, I repeat again. Money supply is directly proportional to monetary base, that is high power money. Money supply is inversely related to cash reserve ratio. Okay, if cash reserve ratio, if RBI keeps more cash reserve ratio CRR, okay, from 4% to 6%, then banks lending ability will decrease, money supply will decrease. If banks decrease the CRR from current 4% to 2%, then banks money supply would increase. Similarly, all banks in the country, apart from cash reserve ratio, they keep more money as excess reserve as a part of cushion. If they keep more money as part of as a cushion, if they keep more money as a part of a cushion, what happened? Money supply will decrease. If they keep less money as a part of a cushion as excess reserve ratio, money supply will increase. I told you, no, they keep excess reserve ratio for the sake of emergency withdrawal or any emergency of loans. Okay. So if every bank keeps excess reserve, because if you keep excess reserve, what happened? Your credit rating of the bank would increase. Credit ranking of the bank would increase. Credit rating of the bank would increase. Okay. Now the problem with is, if banks keep excess reserve ratio, there is an opportunity cost, right? If you keep more and more money as excess reserve ratio, you are losing opportunity to lose. You are losing an opportunity to lend this money elsewhere. Okay, so there is an opportunity cost. Okay, you are foregoing rate of interest. Okay, you are foregoing rate of interest because of CRR. You are foregoing rate of interest because of excess reserve. That is called opportunity cost. Arey boss, money multiplier. How money supply done by RBI will lead to multiplication of money. Okay, money gets multiplied. You look at the equation, Baba. Mukti, look at the equation. You look at the equation here. Money supply is directly proportional to high power money. Time CRR was 48%. Now CRR 4% is okay. More CRR is not required because all banks in the country are angry with RBI because RBI will not pay any rate of interest for CRR balances. Since 2008, RBI stopped paying rate of interest on CRR balances. So banks don't like if RBI increases CRR, okay, because RBI will not pay any rate of interest. So it is a loss on the part of the banks. Moreover, banks also angry that we are losing rate of interest from the RBI. Moreover, had we lent this money to business people, we could have earned rate of interest. So there is a double loss of interest. Am I clear, guys? I'm explaining so simple. Okay, my Hindi is very bad, so I'm not able to explain Hindi. Okay, and you're writing the exam in English, so my Hindi is so bad I can't explain Hindi. Clear now? Please reply, guys. Okay. money multiplier approach to supply of money. Okay, so money multiplier to supply of money identifies three major factors, okay, as determinants of money supply: the stock of high power money, H, the reserve ratio of deposits, R by D, okay, reserves by deposits, the ratio of currency to deposits, C by D. Okay, the stock of high power money, H, the ratio of reserves to deposits, reserves by deposits, and the ratio of currency to deposits, deposits, C by D. Okay, so money multiplier approach to supply of money identified three factors as immediate determinants of supply of money. So we discussed, one is high power money, H. Now ratio of reserves to deposits. Okay, reserves to deposits. So you are depositing 1,000 rupees. How much money bank is keeping as cash reserve ratio, as excess reserve ratio? How much money bank is keeping as cash reserve ratio and excess reserve ratio? So you are depositing 1,000 rupees. How much cash reserve ratio is kept? How much excess reserve ratio is kept by the bank? The ratio of currency to deposit ratio. Right. So your father income is 1,000 rupees. If your papa keeps 500 rupees, so he's keeping more currency with the bank. What is this? Jaspreet Kaur. Understood, sir. Banks will have more CRR. They'll unable to earn interest, but they're not lending that money. Things that directly proportional to me. So if this, they're more. No, Jaspreet, if CRR is low, banks lending ability will be more. If CRR is high, banks lending ability will be low. Okay. Similarly, if your papa keeps more money with the bank, your papa income is 1,000 rupees. Your papa is keeping 700 rupees with the banking system, money supply will be more. The problem is your papa has to buy vegetables, fruits, rice, wheat, everything. So your papa keeping how much money? 10 rupees. Your papa keep 10 rupees with the bank, then less ability. Rishabh, your cursor is not clear. Can you please explain again? What I have to explain again? Huh? मेहमान, मुझको हिंदी नहीं आती आपको समझाने के लिए. इतना सिंपल इंग्लिश लैंग्वेज यूज कर रहे हो इधर. Clear, guys? So behavior of central bank. Okay, I told no. If central bank the supply of money directly proportional to monetary base or high power money, inversely related with R, E, and C. Okay, these ratios we discussed. Behavior of commercial banks. Okay, so we discussed now. If you deposit 100 rupees, every bank has to keep 4% as CRR. So 4 rupees. Okay, so 100 minus 4, 96 rupees only they can lend. Okay, now if the CRR is increased, then banks have to park more funds with the RBI, then money supply decreases. If CRR is decreased, banks have to keep less funds with the RBI, money supply increases. Okay. Now, apart from the CRR, banks also keep excess reserve. Okay, banks also keep excess reserve in the form for the sake of sudden withdrawal by the customers or any loan emergency arises. So they keep excess reserve. Okay, so and any excess reserve kept by the bank involves opportunity cost. This means ये पैसा आप दूसरा जगह में दे सकते हो, वो मौका खो रहे हो. So you're losing opportunity cost. Okay. So whenever deposit is entering into the bank has to segregate certain money as CRR, certain percentage as excess reserve. Mukti currency by deposit ratio. Currency deposit ratio. Currency deposit ratio. C by D means currency deposit. Clear, guys? So actually, out of 100 rupees, see, for example, 4%, 4 rupees gone. I kept another 3 rupees as excess reserve. So 4 plus 3, 7 rupees gone. So 100 minus 7, how much? 93. Now SLR, right? Every bank has to keep certain money as statutory liquidity ratio. So how much is now? 23%. So 93 minus 23, how much? 70 rupees. So banks can lend only 70 rupees to the public. 70 rupees to the public. 100 rupees, you were lending how much? 70 rupees, because 4 rupees gone CRR, 3 rupees gone as excess reserve, 4 plus 3 is 7. Okay. Similarly, 4 plus 3 is 7, and every bank has to keep 23 rupees in the form of statutory liquidity ratio in the form of government securities. So 23 plus 7, 30. So how much they can lend? Only 70 rupees they can lend. Rishabh, CRR increased, then banks have to keep more money with the RBI. So banks' money supply will decrease. If CRR is decreased, banks' money supply will increase. Now, the behavior of the public. Okay, I told you the behavior of the public. If all of you keep less money in hand, then if you keep more money with the banking system, money supply will increase. Money supply will increase. Money supply will increase. So more money supply. So if all of you keep less money in hand, then more money supply with the banking system. If all of you keep more money on your hands, then less money supply will be from the banking sector. Now this topic, currency held by public, becomes irrelevant because now we are not keeping currency in hand because of Paytm, Google, Phone Pay. Nobody is keeping currency on hand, right? You don't require wallet now, right? Nobody keeps wallet, right? You don't require purse, right? Because everybody is paying through Phone Pay, Paytm, Google Pay. So it means you are keeping money with the banking system. Okay. Now if you keep money with the wallet, again, not correct. If you keep money with the banking system, okay. If you pay UPI transaction from the bank using Paytm, Phone Pay, Google Pay, it means you are keeping less money on your hand. I'm not talking about wallet here, right? I'm not talking about wallet money in Paytm. Okay, I'm talking about if you make UPI transaction, okay, using Phone Pay, Paytm, Google Pay, it means you are keeping less money on hand. Okay, you are keeping more money with the banking system. More money with the banking system. So if your father also makes payment using Google Pay, Phone Pay, Paytm instead of cash, it means he's keeping more money with the banking system, keeping less money on his hand, and is contributing to increasing in money supply. Clear? This is a new point. Okay. Now, Karthik, now I answered your question. Okay. You said there is no excess reserve. In this way, there is no excess reserve because, Karthik Gupta, there is no excess reserve because now people are making digital payment transactions. They don't keep money on the hand. That is why it somewhat becomes irrelevant because but still majority of Indians, they keep money, they keep making cash payment transactions. If everybody makes digital payment transactions, then people are keeping less cash on their hand, then there is more money supply in the economy. Yes, Prince, 23 fixed. Clear? Jasprit, I answered your question. Clear, guys? All of you are with me? 7:30 will take a break for 10 minutes. All of you are with me? Clear? Are able to get me, all of you in the class? Can I proceed? So we are just we are summarizing this money multiplier approach. Okay, so size of multiplier determined by required reserve ratio, cash ratio of the central bank, excess reserve ratio of commercial banks, and currency deposit ratio of the public. Okay, lower these ratios, higher the money multiplier is. Higher the money multiplier is. Higher the money multiplier is. Okay, so lower this ratio. Okay, lower this ratio, higher the money multiplier in the economy. In other words, money supply is determined by hyper money, and money multiplier is varies inversely with the varies inversely with the currency cash reserve ratio and excess reserves and currency deposit ratio. Okay, clear? Okay, clear, guys? So let me take a recap what we discussed till now. We discussed what is money supply. Now we discussed money supply is a stock concept, and rationale of measuring money supply we discussed, and source of money supply, and monetary policy deals with money supply in the economy. Okay, now why RBI deals money supply? To ensure the growth of the economy and also control inflation. From 1997, RBI supplies 4 components of money supply: M1, M2, M3, M4. Okay, so on the basis of recommendation of working group on monetary money in 1998, new monetary aggregates are evolved: NMO, NM1, NM2, NM3. Okay, NMO, NM1, NM2, NM3. Okay, NMO, NM1, NM2, NM3. Okay, on the basis of recommendations of working group money in 1998, new monetary aggregates. You see, they're getting new monetary aggregates. Okay, so but they're using the term called liquidity aggregates. Both are same only: L1, L2, L3. Okay, now reserve money, base money, government money, hyper money. Okay, so the money supplied by RBI is called reserve money, hyper money. The measure of hyper money is equal to H is equal to C plus R plus O. Okay, so we discussed this. Okay, and money multiplier, it refers to the degree to which money supply expanded as a result of increase in hyper money. Okay, so this equation is money multiplier is equal to small m is equal to M by H is equal to 1 plus C R plus E plus C upon R plus E plus C. This is what we discussed. Okay, so we discussed that money supply is directly proportional to hyper base and inversely related to R plus E plus C. Clear, guys? Clear? That's all we covered. Discuss. Now next we go to next topic: credit creation by commercial banks. 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 Now try to understand me here. You need to understand very important thing here. You deposit 100 rupees in the bank, right? When you deposit 100 rupees in the bank, so I need to take care of your deposits. Okay, cash reserve ratio is one of the ways to take care of your deposits. RBI says, please keep 4% of that 100 rupees with me in the form of cash. So 100 rupees, 4% is 4 rupees. So every bank has to keep 4 rupees with the RBI in the form of cash reserve ratio. The purpose of cash reserve ratio is to protect the interest of the customer who deposited money in the banking system. Okay, purpose of cash reserve is to protect the interest of the customer who deposited money in the banking system. Of course, apart from cash reserve ratio, we have a bank. Your money is deposited money is insured also. Okay, worth 1 lakh rupees money of yours is insured also. Okay, banking insurance also there. Now, what does bank will do? 4 rupees I keep as with RBI as part of cash reserve ratio, mandatory, compulsory for all the commercial banks in the country. All the banks in the country have to keep 4%. Okay, whether private bank or scheduled bank or foreign bank, you have to keep 4% of your deposits with RBI in the form of CRR, so cash reserve ratio. Okay, in the form of cash. So 100 rupees minus 4, I have 96 rupees. Now, out of 100 rupees, what I do, I'm worried tomorrow any withdrawal might happen, excess withdrawal might happen, or a customer might come for a loan for the bank. I may not have sufficient funds. So to avoid this, I keep certain money as excess reserve. To avoid this, I keep certain money as excess reserve. So how much I keep excess reserve? 3 rupees. Okay, so 4 plus 3, 7 rupees. 3 rupees excess reserve with whom? Excess reserve lies with the State Bank of India only, Punjab National Bank only. CRR has gone to RBI. CRR has gone to RBI. Only 3 rupees excess reserve I am keeping. Okay, now out of 100 rupees, 23% I have to keep as SLR in government approved securities. SLR, statutory liquidity ratio. Out of total deposits, every bank has to keep 23% as approved government securities with RBI. So approved government securities, 23 rupees. Okay, now 23 rupees also gone to RBI. So 4 plus 23. Okay, 4 plus 23, how much? 23, 4 plus 23, 27, plus 3 rupees I kept as excess reserve. So 30. So how much money I have? 70 rupees. 70 rupees. 70 rupees, what I have to do? I have to do lending. I have to do lending. Why I have to do lending? Because you deposited 100 rupees in the banking system. I need to pay a rate of interest of 3%. Okay. That is called deposit rate or interest on savings account. I need to pay a rate of interest of 3% on your savings deposits. How can you pay a rate of interest on your savings deposits or a deposit rate? How can I pay? Unless I lend your money to other individual or corporate or a business. Okay, I need to lend your money to other business or other individual or other corporate. Okay, so I lend. So how I lend? When I lend money to somebody else, I will charge high rate of interest. Okay, so I will charge him some 10%, 12% rate of interest, and I pay you 3% rate of interest. The difference between what I charge to the lender and what I pay you as a depositor, the difference is my profit. The difference is my profit. So while I lend money to others, I charge more, and when I pay you less. The difference is called my profit. Clear, guys? Clear, guys? All of you are with me? Clear? Is it clear with you, all of you? Okay. Is it clear with you, all of you? So I repeat again. You depositing 100 rupees, I need to keep 4% as CRR, cash reserve ratio. This is decided by central bank in the country. India Central Bank, RBI decided 4% you should keep with me as in the form of cash. Why? To protect the interest of the depositor. So 4 rupees gone. Now I also keep 3 rupees extra as form of excess reserve in case of sudden withdrawal or or any loan emergency arises to the bank, I need to have funds. I keep 3 rupees as excess reserve. So I keep excess reserve, and moreover, out of total deposits 100, I need to keep 23% as a form of statutory liquidity ratio. I need to keep these funds in the form of approved government securities with the RPI. The purpose of SLR is to protect the bank from lending. Okay, if anything happens to bank lending, okay, any default happens, SLR saves the bank. SLR saves the bank. SLR saves the bank. CRR is to protect the interest of the customer. SLR is to protect the bank in case of any problem arises from the lending. Profit not clear, Manish. See, when you deposit 100 rupees, I pay 4% rate of interest. Okay, I pay you 3% rate of interest. How I get this interest? By lending your money to the individuals or business people. So when I lend this money, I charge them more. How much I charge them? 10%. How much I'm paying? 3%. 10% minus 3%, 7% is my profit, my earnings. So clear. Yes, Jasprit, you're right. Right. Okay. So we need to continue this topic. So it's one of the outstanding feature of commercial banks. What? Okay. So they credit creation is outstanding feature of the commercial banks. So what happened? So the loan. Suppose I give loan to you. Okay. So I give a loan to Prince. Prince deposits my check in the other bank. So loan given to somebody becomes deposit for the other bank. So this process will can be explained with the help of a small example. Okay. So here we are taking as cash reserve ratio as 20%. Okay, 20% the cash reserve ratio. So okay, 20% as we're keeping as a reserves. So out of the deposit received from X, okay, out of deposit received from X, we are keeping 20% as reserve. So credit multiplier is equal to credit multiplier is a reciprocal of 1 by required reserve ratio. 1 by is a reciprocal of 1 by required reserve ratio. 1 upon 0.20 is equal to 5. I'll explain with example to understand better. Okay, look at here. I have taken balance sheet of bank A. Balance sheet of bank A. Okay, so X deposited how much? 1,000. X deposited how much? 1,000. Okay, so assets of the bank is how much? 1,000. 1,000. Okay, this is a balance sheet of the bank A. Okay, X deposited 1,000 rupees. This is a balance sheet of the bank A. Balance sheet of bank A, 1,000 rupees. Cash 1,000 rupees. Cash 1,000 rupees. Okay. Now, so what bank has to do? Bank has to keep certain money as reserve ratio, cash reserve ratio. Look at here. Banks kept how much? How much reserve ratio? How much reserve ratio we discussed here? Okay. How much? 20%. So 1,000 of 20% is 200. So what I do? So 200 rupees I kept reserve. Okay, 200 rupees I kept as reserves. Okay, now I given loan to X. Loan to X. Why I given loan to X? I given loan to X because I need to pay rate of interest on the deposits of the customer. So I given loan to X. I given loan to X. So I repeat again. A customer deposited 1,000 rupees in the bank. Okay. Now my cash is 1,000. Deposits 1,000. Now I kept reserve 20% means 200. Loan to X 800. Okay, so I given loan to X. Why? Because I need to pay rate of interest on the deposits. So 1000. So what X will do? X will deposit this check in the bank B. X will deposit the check in the bank B. X will deposit the check in bank B. So cash is equal to 800. Deposit is equal to 800. Cash is equal to 800. Deposit is equal to 800. Okay. Now, okay. So what balance sheet? Now look at the balance sheet of bank B. Balance sheet B. Bank B also keep 20% as reserves, 160, and it bought securities from Z. Okay. Don't call it Jet. It's called Z. It bought securities from G. Okay. Now 800. Okay. Now what Z will do? G will deposit this check in bank C. So deposit 640, reserves 640. Deposit 640, reserves 640. Deposit 640, reserves 640. Okay. Now, okay. Now, okay. So clear? I'll explain whole thing again. Balance sheet. So a customer deposited 1000 rupees in bank A, 1000, cash 1000. So balance sheet of the bank is 1000. Now what bank A will do? Bank A will keep certain percentage to 20% of 1000, 200 as reserve, and gives loan to X. Okay. Why it is giving loan to X? Because it has to pay interest on the deposits. X will deposit the check in bank B. Cash 800, deposits 800. Okay, cash 800, deposit 800. Now, okay. Now what bank will do? Bank has to pay. Bank has to keep certain percentage, 20% as reserves, 160, and it bought securities from Z by giving him check. So 640 rupees worth of securities it got, and it gave a check to Z, and Z deposit the check in the bank C. Okay, deposit and it should be cash. Sorry, it should be cash. Okay, not reserves. It should be cash. Okay, not reserves. Okay. This should be cash. Deposits and cash. Deposits and cash, not reserves. Cash. This is not reserves. Cash. How long this process will continue? Now bank C also will keep certain percentage as reserve, 20% of 640. How much? 20% of 640. How much? 640 into 20%. How much? Can you tell me? $128 as reserves, and 640 minus 128, 512. It will give to somebody else. Okay? It will give to somebody else. How long this process will continue? This process will continue till the original excess reserve. Okay. What is the original excess reserve? 800 has been parceled out. Okay. First 800 excess reserve from the first bank has been parceled out to various banks. Okay. The total deposits which created over a period of time 5 times the original deposits. 5 times the original deposits. Potential credit expansion is equal to initial excess reserve into 1 upon cash reserve ratio. So 800 is the initial excess reserve, okay, into 1 upon 20 is equal to 4,000. Is equal to 4,000. So the total deposits created in the banking system are 5,000. Okay, in the bank, which includes 1,000 original deposits and remaining 4,000 made by the banking system. Clear? Yes, yes. Now I said the same thing, 640 minus 512. Clear? Clear, guys? Clear? Let us keep the recap. A customer deposited how much money in the bank A? 1,000. Cash 1,000, deposits 1,000. So bank A will keep reserves how much? 20%, 200. Loan to X 800. So 1,000, 1,000. So loan to X, how it is? Bank A is given by giving a check. So he deposits X deposits check in the bank B. Deposits 800, cash 800. Okay. Okay. Now what bank will do? Bank B will do, it keeps 20% of that, 160, and deposits 800, and it bought securities from Z. How much? 640. Okay. Now when it bought securities from Z, it issued a check. It issued a check. Now Z will deposit check in the bank C. Deposits 640, cash, it's not reserves, mein galti likha hai, it is cash 640. Now bank C will keep 20% of 640, that is 128, and issues 512 to the other customer. Now this process will continue till the initial excess reserve, that is 800 from the first bank, has been parceled out to various banks. The total deposits which gets created in the banking system over a period of time, 5 times the original deposits. Potential credit expansion is equal to initial excess reserve into 1 upon cash reserve ratio. 1 upon cash reserve ratio. 800 into 1 by 20 is equal to 4,000. Okay, 800 is the initial excess reserve. Okay, and cash reserve is 1 by 20 is equal to 4,000. The total deposits created in the banking system are 5,000, which includes original initial deposit of 1,000 rupees, and banking system created 4,000 rupees. The total deposits created in banking system is 5,000. Clear? Clear now? Clear, guys? Clear? You have any doubts, please? This chapter is slightly difficult. All monetary aggregates you have to do ratta, no other option. Okay, this will be useful for solving numericals and MCQs. Okay, don't think much into that. Do that, especially liquidity aggregates. No, you don't apply much head into that. Do ratta in that. Okay, you need to learn that. Okay, rest of the concepts are very clear. Okay, I cleared all other concepts. Clear? Any doubts? Do you have any doubts, please? Do you have any doubts? Please ask me. We're taking break at 7:30. Any doubts, please ask me. So I repeat again, this process, how long this process of blending continue? Since the original excess reserve of the first bank 800 has been parceled out to various banks, the total deposits which gets created in the banking system over a period of time, 5 times of the original deposits. Potential credit expansion is equal to initial excess reserve into 1 upon cash reserve ratio. 800 is equal to 800 is what? Initial excess reserve into 1 by 20, okay, is equal to 4,000. This 4,000 created by banking system and original deposit is 1,000. So total deposit created in the banking system is 5,000. Clear, guys? Clear. I'll upload this PPT. Don't worry. Okay. Any doubts? Well, before you take break, please ask me. And I don't know Hindi to explain this subject. Okay. Please, but I'm explaining simple language only. I cleared all your doubts. Okay. I cleared all your doubts. CRR should be kept in the cash by commercial banks with RBI, and SLR should be kept in 23% of total deposits in the form of approved government securities. The money supplied by RBI is called high power money, monetary base money, government money. All names are same. All names are same. Clear? Thank you. You're able to follow me. Okay. No. In the example, Pooja, it is coming 5 times. See, 800 rupees excess reserve resulting in 4,000 rupees and 1,000 rupees original deposits. So in the example, it's coming 5,000 rupees. Okay. Okay. In the example, it is coming as 5,000. You can use the same example in the exam also. Pooja, I'm clear. Clear? Any other doubts? And that equation M upon H is equal to 1 plus C upon C plus E plus M upon H. 1 plus C is equal to C plus R plus C. With the equation you need to remember. Clear? Clear, guys? Any doubts? This is very important equation. M upon H is equal to 1 plus C upon R plus E plus C, where money supply is directly proportional to high power money. Money supply is inversely related to R, E, and C. Clear, guys? Sir, are you there? Hello? Hello, are you there, sir? Welcome back after the break. And Pooja asking, I was not asking about 5,000 rupees, sir. I had a doubt. The second point, where deposits were 5,000. Pooja, where is your doubt, Pooja? I'll go back to the slide. See, in the first bank, you find initial excess reserve how much? 800, right? Now, how long this process will continue? Till the initial excess reserve of 800 rupees for the first bank has been parceled out to various banks. Okay, has been parceled out to various banks. Okay, bank A, B, C, D, E. Right. Now, I want to know how much total deposits created in the banking system. So we have original deposit of 1,000 from the customer who deposited in bank A, and banking industry itself created worth of 4,000 rupees. Okay. Now, how did they create 4,000 worth of banking deposits? There is a formula: potential credit expansion is equal to initial excess reserve upon 1 by cash reserve ratio. So 800 into 1 by 20 is equal to 4,000. So the total deposits created in the banking system is 4,000 through the banking system, 1,000 rupees original deposits, total deposits 5,000. Pooja, am I clear? Pooja, I'm clear, Pooja. So this is a separate topic: monetary policy and money supply. Try to follow me here. Okay. Now, RBI always wants to stimulate the economy. Okay. How they stimulate the economy? Suppose there is inflation in the economy, they'll suck out the liquidity. Okay. Suppose economy needs funds and there is falling prices or deflation, and RBI pumps in money supply. Okay. If there is inflation, RBI takes out money. If there is a slowdown, okay, or deflation or falling price level, RBI supplies money into the economy. Okay. Now RBI keeps on stimulating the economy. Okay. So one of the ways RBI is stimulating the economy is a separate topic. Monetary policy, money supply is a separate chapter. So how does RBI stimulate the economy? Through open market operations. Okay. Through open market operations, RBI stimulates the economy. Okay. So what is open market operations? Buying and selling of securities by RBI in the open market is called open market operations. Okay. Buying and selling of securities. Okay. Or purchasing and selling of securities, or buying and selling of securities. Suppose I want infuse liquidity into the banking system. What I do? I buy the securities. Once I buy the securities will come from banking industry to RBI. Cash will go from RBI to banking industry, so that lending ability of the banks will increase. Suppose there is inflation in the economy. Okay, it means inflation means what? Too much money chasing too few goods, right? Now, inflation means I need to suck out liquidity. What I'll do? I will sell the securities. Securities मेरा हाथ में है ना, मैं विक्रय करूंगा. When I sell the securities मेरा हाथ से banking industry के पास जाएगा, and banking industry से पैसा मेरा हाथ में आएगा. So this is called open market operations. It's called open market operations. Open market operations. Okay. Open market operations, buying and selling securities by RBI in the market. Now look at here. Now through open market operations, assume there is a slowdown in the economy, or economy in dire need of funds. So RBI wants to infuse liquidity. Okay. So this is assumed that banks don't hold any excess reserves, or people don't hold more currency than before, and there is a demand for loans from the banking industry. When there is a demand for loans from the banking industry, see, there is demand for loans from the business community. There is demand for loans from the business community. Okay, and banks don't have excess reserve. and people don't hold more money currency than before, and business community requires liquidity, loans. Okay, loans. So looking RBI has the information that business community requires the loans. So what does RBI do? RBI indulges in open market more, employment is more, income is more, output is nothing but GDP of the country, output is nothing but growth of the economy. I repeat again, the moment banks get the liquidity, what they do, they decrease the lending rate. Once they decrease the lending rate, all business community, corporates, they borrow money from the banking sector. When they borrow, they start investing. They start investing, then they're producing more. Output is nothing but GDP, growth of the economy. Employment will increase, national income will increase. Okay, so when RBI purchase securities, there is increase in money supply is shown as delta. Change in money supply is shown as change in money supply is equal to 1 by reserves, 1 by R into change in reserves, 1 upon R into change in reserves. Okay, change in money supply. Why change in money supply is happening? Because RBI purchasing securities from commercial banks. So change in money supply is equal to 1 upon R into change in reserves. Reserves what? Cash reserves of the commercial banks, because RBI purchasing securities. So this is called the formula. Suppose there is inflation. Therefore, there is inflation in the economy. Then RBI what will do? RBI will sell the securities. The securities from the RBI will go to commercial banks. RBI will go to commercial banks, and the reserves will decrease in the similar fashion. Clear, guys? Himanshu, RBI will not sell securities. The securities is RBI will not supply money directly to the public. RBI supplies money through banking industry. Clear, guys? Okay. See, economy, whenever economy needs in money supply, RBI through open market operations by purchasing securities, RBI increase the money supply in the economy. Suppose there is inflation in the economy, then RBI will suck out liquidity by selling securities. So liquidity goes into the hands of RBI, and securities will go into the hands of commercial banks. Am I clear, guys? Okay. Okay. Now, effect of government expenditure on money supply. Effect of government expenditure on money supply. Okay. So sometimes what happened? RBI takes overdraft. Government takes overdraft. Okay. Okay. RBI takes government takes overdraft, ways and means of advances. Okay. So whenever government takes overdraft or ways and means of advances, through ways and means of advances, and so why government is taking overdraft and ways and means of advances? To incur government expenditure. Okay, when government ran out of funds, or it may use overdraft, borrow money from overdraft or ways and means of advances. So what happens? It debits the balance sheet of government account from the RBI, and creating the account of the receiver. Okay, who is the receiver? Suppose I'm a worker. Okay, I'm a worker. I have a bank account. Right now, since RBI debited the government bank account, the same amount will be credited to the bank account of a customer. Okay, now customer uses this money and start spending on goods and services. When customers start spending goods and services, then demand for goods increases. Demand for goods services increases. Then firms will borrow more money from the banks, start investing more, and output increases. Employment increases. National income increases. Output is nothing but GDP or growth of the economy. Himanshu, I'm not understand what is R. Where is R? I'm not able to understand what is R. Clear, guys? Clear? Now, practice questions. Okay? Practice questions. What do you mean by reserve money? Okay? You need to write the answers. Okay? The money supplied by RBI is called reserve money, high power money, base money, government money. So how to determine the size of the multiplier? That will be discussed. Commercial banks are manufacturer of credit in the economy. Explain. How does ways and means advances affect the money supply in the economy? So I told you, whenever government takes overdraft, the RBI as the bank account of Government of India, the amount will be debited in the balance sheet of the Government of India, and the same amount will be credited to the customer in the bank, and customer borrows that money, start demanding goods and services. Then customers start demanding goods and services, demand for the good increases. Looking at the demand for goods and services, firms will borrow more money from the bank, start investing more, output increases, employment increases, national income increases. How does explain money multiplier approach to money supply? This also we discussed. Okay. Let us discuss few true or false questions. Money supply is inversely related to H and directly related to R. Mansha, look at here. Crowding out will not come here. Okay. Crowding out here, government is taking overdraft as ways and means advances, right? Government, whenever short of funds, taking ways and means overdraft. Okay, now then it's taking overdraft. The balance sheet of Government of India is RBI. It will get debited in the balance sheet of the Government of India balance sheet, and that amount will be credited to the customer of the bank who is the beneficiary of the government unemployment allowance or widow allowance. Some allowance government is unemployment allowance, sick allowance, widow allowance. So the beneficiary draws that money from the bank and he starts demanding goods and services. Okay, when he starts demanding goods and services, demand for goods, the firms will invest more. So firms will borrow more from the banks, invest more, output will increase, and employment increase, national income will increase. Okay, first one is false, right? Supply of money is stock concept. True. Money supply might impact inflation in the economy. Yes, true. M2 includes post office saving deposits. True. M is inversely related to M. Money supply is inversely related to C. True. Clear, guys? Clear? Let us take few MCQs. Okay. Okay. Which of the following is known as a broad money? Which of the following is known as broad money? M1, M2, M3, M4. What is your answer here? Which of the following is known as broad money? M1, M2, M3, M4. Broad money. Which of the following is known as Furkan? Check your answer. First is M3. Money supply refers to the sum of money held by public, banks, government, RBI. Money supply refers to the sum of money held by public, banks, government, RBI. Money supply refers to sum of money held by public, banks, government, RBI. What is the answer for second question? No one is answering here. Money supply refers to the sum of money held by. Second question. Oh, you type. Second question answer is public. Oh, you have to zoom. Okay, 1 second. Fine. Grini? Okay, money supply refers to the money supply held by public. Supply of money is a flow variable, stock variable. A combination of stock and flow variable cannot be categorized. Question number 3. Question number 3, answer. Supply of money is a flow variable, stock variable, a combination of stock and flow variable, and cannot be categorized. Cannot be categorized. Supply of money is a flow variable, stock variable, a combination of stock and flow variable. Yes. 3B. M1 does not include A. Time deposits in the banking system, currency in circulation. C. Demand deposits in the banking system. D. Other deposits. Question number 4. M1 does not include. M1 does not include. For A. Time deposits. Money supply is directly proportional to. Money supply is directly proportional to A. Cash reserve ratio, monetary base, currency deposit ratio, money multiplier. Fifth one. Money supply is directly proportional to A. Cash reserve ratio, monetary base, currency deposit ratio, money multiplier. Fifth question, answer. 5B, monetary base. Reserve money is supplied by. Who supplies reserve money? Sixth question, answer. Reserve money is supplied by. Reserve money is supplied by. Yes, reserve money is supplied by RBI. Calculate M1 from the following data. Calculate M1 from the following data. Calculate M1 from the following data. Calculate. One second. Sir, fine, no issue, sir. Okay. Calculate M1 from the following money aggregates. Okay. Yeah. What is M1 here? Value M1. M1. What is the value of M1? What is the value of M1 here? M3. Sorry. Calculate M1 from the following monetary aggregates. Question number 7. Calculate M1. Take your own time. Calculate M1. We have currency with the public, other deposits with RBI, banker deposits with the RBI, demand deposits, time deposits. Seven A, right answer. Calculate M3 from the following monetary aggregates. M3. So you're going to add M1 plus time deposits. Eighth one. What is the answer for the eighth one? Eighth question answer is B. Okay. Now ninth question is slightly, I made it difficult for you. Okay. If the required reserve ratio is 20% and currency circulation is 800 billion, demand deposits are 2000 billion, excess reserve 2 billion, find the value of multiplier. Find the value of multiplier. The required reserve ratio is 20%, currency circulation is 800 billion, demand deposits are 2000 billion, excess reserves are 2 billion, find the value of multiplier. Slightly difficult question I asked. So how do you calculate this? Required reserve ratio is 20%. 20% means 0.20. Currency in circulation is 800 billion. Demand deposits is 2000 billion. Excess reserve is 2 billion. So no issue, no issue. I gave the numerical for them to solve, sir. Okay. What is the value of money multiplier here? Kartik, Pooja. You have R value 20%. 20% is equal to 0.20. And we have currency circulation 800 billion. And demand deposits are 2000 billion. Excess reserve is 2 billion. So how you calculate money supply? Kaushia Sahu, your answer is right. 9th 2.50. I'll give you explanation here. Okay, look at here. So R is given 20% is equal to 0.20. Currency circulation is how much? 800 billion. Okay. R is equal to 0.20, 20%. Demand deposits 2000 billion. Excess reserve is 2 billion. Money supply is equal to M is equal to currency plus deposits. That is 2000 plus 800, 2800 billion. And currency deposit ratio C by D is equal to 800 billion by 2000 billion. That is equal to 0.4. So depositors hold 40% of their money in the form of currency. 40% of their money in the form of currency. So 100 rupees my income, I keep 40 rupees as in the form of currency. Okay. Now excess reserve, right? Excess reserve, how much? 2 billion upon 2000. So 0.001. Okay. It means banks are holding 0.1% of the total deposits as excess reserve. So money multiplier is equal to M upon H is equal to 1 plus C R plus E plus C. So 1 plus 0.4 upon 0.2. So these values are here now. Plus 0.001 plus 0.4. 1.5 upon 0.601 is equal to 2.50. Clear now? I solved the numerical. Clear, guys? Look at here. See, reserve ratio is how much? 20%. Okay, this is your cash reserve ratio. Cash reserve ratio. How much? 20% means what? 0.20. Currency in circulation is how much? 800 billion. Demand deposits 2000 billion. Excess reserve 2 billion. I wrote all the values. Now I calculate money supply. Currency, money supply is equal to currency plus deposits. 2000 plus 2 billion, 2800 billion. Now currency, I am calculating currency deposit ratio C by D. 800 upon 2000 is equal to 0.4. It means 40% of the deposits held by public as currency. Excess reserve is equal to 2 billion upon 2000 is equal to 0.001. It means 0.1% as deposits held by banks as reserves. So money multiplier formula M upon H is equal to 1 plus C R plus E by R plus E plus by C. So substitute those values. Clear, guys? Understood? Understood? Pooja, clear? Pooja, clear? Everyone clear? 0.4% means 40%. Clear, guys? Clear? Clear, guys? Is it clear? Numerical is clear. From cash reserve ratio 20% means 0.20. Currency circulation 800 billion. Demand deposits, excess reserve 2 billion. And we are calculating money supply here. Currency plus deposits 2800. Now I calculate currency deposit ratio C by D. Then excess reserve also I calculate over the banks. That is 0.1% of the total deposits. Money multiplier we calculated by substituting those values. Now look at the 10th question. Bank earned profit on difference between interest charged on loans and interest paid on deposits. Clear? Clear, guys? Okay. So let me take you to the PPT again. The whole money supply PPT here. Okay. We run through all this PPT again. So money supply chapter, we discussed all these things. What is money supply? We discussed. Supply and money supply components we discussed. Recommendations of working group on money aggregates we discussed. Recommendation of working group on money 1998 new monetary aggregates, liquidity aggregates are discussed. Reserve money, base money, high power money we discussed. Okay, money multiplier we discussed. Okay, and money multiplier also discussed. Okay, and money multiplier approach to supply of money we discussed. The behavior of central banks with regard to CRR. The behavior of commercial banks with regard to excess reserve. The behavior of public with regard to currency deposit ratio we discussed. Okay, and credit creation of commercial banks we discussed. And we also discussed this important formula. Okay, potential credit expansion is equal to initial excess reserve into 1 by cash reserve ratio. And monetary policy money supply we discussed how through open market operations RBI can increase the money supply in the economy we discussed. We also discussed effects of government expenditure on money supply whenever government takes an overdraft or ways and means advances. Okay, and government account will be debited and the amount will be transferred to the customer who is receiving unemployment allowance or sick allowance, widow allowance, amount will be created. So this is how. So when bank account of a customer is created, it will lead to increase in money supply in the economy. Okay. Now another 10 minutes is there. I will tell you a beautiful story. Now there lived a ghee seller. Okay. This ghee seller, what does he do? He used to sell adulterated ghee. Adulterated ghee. Okay, when he sells adulterated ghee in the village, there is no other choice. People continues to buy ghee from him because there is no choice. So they know it's adulterated ghee, and there is no other way. So one day, if you keep on committing sin, one day you will be caught. Even I will be caught. So this ghee seller is caught. Okay, he's being brought before the panchayat, and panchayat tells him, you have been selling adulterated ghee, and you have to go through the punishment. I'll give you 3 choice of punishments, and you choose any one of those punishments. First punishment is he has to drink one glass of ghee. He has to drink 1 glass of the adulterated ghee. Second punishment is he has to pay 1 lakh rupees as punishment. Third is he has to take 100 pips. So first he has to drink 1 glass of adulterated ghee, choice, or take 100 pips. Third, he has to pay a fine of 1 lakh rupees. So this businessman, he thinks in a business way, Array, why should I pay 1 lakh rupees fine? Why should I take 100 whips on my back? It will be aching. I'll drink the 1 glass of ghee. So he takes that one glass of ghee offered to him from his shop. While taking the ghee only, he realizes how bad ghee he has been selling to the customers. Okay, and he takes one sip, two sip, third sip. He put down the glass. Arey Baba, I can't drink this tea. I can't drink this tea. Okay, now says, sir, I can't drink this ghee. And he realized how bad ghee is now he's selling to the customers. Sir, I will take 100 bips. 100 bips. So the man is called out and he start whipping the seller, and one whip, two whip, third whip, fourth whip, up. Sir, stop. I'll pay 1 lakh rupees. Okay, he pays 1 lakh rupees. Now, if you tell this story in any IIMs or IITs or any big institutions, Harvard, sir, he's a stupid fellow, sir. If I were in his position, I would have paid 1 lakh rupees. No, it is the karma that you have to go through. He's going through his karma. His karma written that first he's going to drink a little bit of ghee, take whips, and pay 1 lakh rupees fine. But after paying 1 lakh rupees fine, would anybody buy ghee from this shop fellow again future? Nobody will buy. Okay, nobody will, because he lost his credibility. Suppose tomorrow he keeps a chappal shop or garment shop. Nobody will buy garments, chappals from this fellow because he lost his credibility. Okay, and because of this fellow, his family, his wife, kids lost name in the society. Now nobody likes them because they think na uska bibi hai, okay, uska bachche hai, right? Now they didn't do anything wrong. His father did the wrong thing. Wife got a bad name. Kids at the school got a bad name. Everybody saying that ye na iska papa hai na, he sells adulterated ghee. Now, even if he moves from village A to village B, all villages are somewhat hardly separated by a few kilometers, right? 10 kilometers, 7 kilometers. Village A people will tell village B people, "Arey, wo hai na hamara shop mein, he sold this ghee, adulterated ghee. Please don't buy from him." Okay, what I mean to say is, credibility is very important for all of us. Okay, credibility is very important for all of us. Once you lose credibility, you can never get back. Okay, so all of us, we need to maintain our credibility. All of us, we need to maintain our credibility. So how do you lose credibility? If you tell one lie, or I will not do this again, I will sell proper ghee. Now he realized his mistake, is repenting his mistake, he wants to change, he wants to sell good ghee, and world is not willing to listen. World is not willing to listen. So never ever lose your credibility. Never ever lose credibility. Once you lose your credibility, you will never get back. Once you lose your credibility, you will never get back. So credibility is very important for all of us, including me. Credibility is very important. So credibility to maintain means what? That you maintain your integrity, honesty, you speak truth. Okay, and okay, you don't tell lies. Okay, it's very important part of credibility. For product, it is called brand identity. Okay, for us, it's called credibility. For product, it's called brand identity. Why Uninar mobile phone got killed and buried? Why Aircel mobile phone got killed and buried? Because these products don't enjoy credibility in the market. So credibility is very important. Very important, right? See, one is adulterated ghee. Whatever mistake that you do, one day you will be caught. Okay, today you will not be caught. Tomorrow you will not be caught. Day after tomorrow, or next week, or next month, or next year, you will be caught. Once you are caught, you lose your credibility. So credibility is very, 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 very important. So we need to nurture our credibility. We need to maintain our credibility. Okay, such a way that even what is happening here. Online exams are happening across all the colleges last 2 years. Everyone is copying. But in my class of 70 students, 60 students, I find 2-3 students, they are not copying, they're writing their original answers. I gave them good marks. Students who copied, actually I gave less marks because copying. When I asked these 3 students why you didn't copy, sir, I'm against copying. When against copying. When I asked them, when now college got opened up, now students have to come appear for the offline exams. They're afraid to come to college because all this confidence. So 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 you see this out of 70 students, 2-3 students, they didn't copy. I like them because of their credibility they maintained. The credibility I gave them good marks, but they didn't copy at all. Sir, I'm against copy. See the conviction. I'm against copy. Okay, against copy. They didn't copy anything. They didn't copy anything. Okay, and some students know, sir, I'm not able to switch on the camera, sir. My camera, there's a problem. All lies. All lies. So network is low, sir. Network काम नहीं कर रहे. So everything. Okay, when you speak lies, and the moment you keep on speaking lies, one day you lose credibility. Once you lose credibility, nobody will trust you. Your father will not trust you. Your brother will not trust you. Mother will not trust you. Okay, they will not trust you. So never ever lose credibility. Credibility is very, very important to all of us. We all of us need to maintain credibility. So credibility. I'll tell you another example. Right. So some people, what they do, they visited from one place to other place in a auto expenses are 60 rupees. So what they write in the bill, they write in the bill as 120 rupees, and the bill will be passed. The bill will be passed in the account section. Bill will be passed, but don't think account pass section is stupid person. He knows how much from place A to place B, how much auto expenses cost 60 rupees, but you wrote 120 rupees, he'll pass. Tomorrow any promotion interviews come, they won't even select you. Okay, huh? They don't even select you. They don't even select you for the job. And you have all the qualification. You are better than your colleagues. Still you are not selected. You will not be selected because of this record. Okay, you always claimed wrong expenses. Okay, this is what I'm saying, that just because of auto expenses shown wrongly account, why will they promote you for a higher position? They don't want to take this risk. They don't want to take this risk. They don't want to take this risk. They don't want to take. Okay, so credibility is very important. Hope all of you liked my moral story. Plus today onwards, maintain your credibility. Okay, very important. Okay, never ever lose credibility. And now what I get out of credibility, returns you get in the long run, not in the short run. Okay, out of 70 students, 2-3 students are not copying. They enjoy more credibility with me. Other 67 students don't have any credibility with me. Okay, clear? Understood the moral story? Pooja, I'm talking about credibility. Okay, credibility, you, me, everyone should maintain. Okay, so how do you lose credibility? One lie, okay, one cheating, okay, anything you do unethical, then you lose your credibility. Okay, once you lose your credibility, then you will never get back. Nobody will trust you. Okay, now losing trust on themselves because you don't study well for CA exams. So when you don't study well for CA exams are starting on Monday, you don't have the confidence, then you fail. So you don't have trust means you didn't work hard. When you don't work hard, you lose confidence. That's a different thing. I'm talking about credibility. Okay, credibility with whom? Credibility with your mama, credibility with your father, credibility with your teacher. Okay, credibility with your friends. Okay, so they say, hey, this Lakshmi, Amesha tells lies. Why they say that? Okay, hey, don't talk to Lakshmi. She always tells lies. Why? Because Lakshmi has no credibility. Hey, don't talk to Raju. Raju all tells lies. Why they say that? Raju speaks lies. So Raju is labeled as lies. If tomorrow Lakshmi, Raju speaks truth also, nobody is there to listen to them. Okay, this is what I'm saying. Thank you. Hope you liked my story, all of you in the class. Thank you. So are you there? Yes, yes, sir. Thank you.